In this video, I will reveal a strategy that has made me over $50,000 in the past 6 months, and it's called the Catalyst Gap Play. This one strategy has been working out really nicely with very high risk to reward rates, and in this video, I will be sharing everything you need to know to capitalize on this strategy. This catalyst gap play works the best if the stock being traded has some sort of news catalyst which attracts a lot of attention from human traders and algorithms, leading to high volume on that particular stock. This does not mean trading through news catalyst. For example, if a stock is reporting earnings, I don't recommend to hold any trades overnight because that is practically gambling your money. A stock can report the best earnings in the world and it might gap down the next day, or the stock might report the worst earnings in the world and it might gap up the next day. So the news release is not directly correlated with the price action of the stock. So this basically means that in this strategy, you're not trading the news, but you're trading the market's reaction to the news and trying to capitalize on the increase in volatility after the news release. This strategy works the best if the stock you're trading has these 3 points. The first point is that the market cap of this stock is in the large cap region. That means the market cap is between $10 billion to $200 billion. If you don't know what market cap is, in very simple basic terms, it's just the total valuation of the company. And why the market cap is important will be explained in the next point. So that brings us to the second point, which is that this stock is gapping up or gapping down less than 15% after the news release. As you guys know, I like to keep it really simple on this channel because honestly, that's how you make money from the stock market. People who overcomplicate things don't make money in the stock market. So I'm going to be explaining these 2 points with the help of an example. Let's take an example of 2 companies, stock A with a market cap of $1 trillion and stock B with a market cap of $50 billion. Stock A with the $1 trillion market cap is a mega cap company because any company with a market cap of more than $200 billion is called mega cap, and stock B is a large cap because the valuation of that company lies in between $10 billion to $200 billion. So now let's say after the news release, both these stocks are gapping up by 10%. So 10% of stock A, that means $100 billion. So if that stock is gapping up 10%, that means there's an inflow of approximately $100 billion in that company overnight. Similarly for stock B, if stock B is gapping up by 10%, that means in the case of stock B, it has an inflow of only $5 billion compared to $100 billion of stock A. So this was all very simple, but to make it even more simpler, it takes a lot of money to move stock A by 10% compared to stock B. And this is the exact reason why companies like Amazon, Google, Apple, if these companies are gapping up more than 10% after the news release like earnings, they most likely close like a doji on the one-day chart because a lot of inflow and outflow of money has already happened overnight. So the first point was that the market cap of this company is between $10 to $200 billion. The second point was that this stock is gapping up not more than 15% after the news release. That brings us to the third point, and the third point is that this stock is gapping up or gapping down above or below a critical level that you mark on the higher time frames like the 1 week or the 1 month chart. So now let's dive into the chart and try to explain these 3 points and your potential entries and exits with the help of a few examples. But before we do that, make sure that you give this video a thumbs up. So let's take an example of ANET because this is a stock that I traded recently and I made approximately 100% of my investment on this trade. So let's take a look at the market cap. You guys can't see it because my face is blocking the market cap, but it's approximately 55 billion at the moment. But before the earnings, it was holding around 45 billion. But again, we don't need the exact value. We just need an approximate range. Anything large cap is pretty good. So between 10 to 200 billion, and this is in a very sweet spot around 45 to 55 billion. So this company, ANET, reported earnings on 31st of July, and they reported pretty good earnings, green. So they beat the earnings. But again, we don't care about the earnings. We don't trade the news. We trade the market's reaction to the news. Market reaction the following day was positive because sometimes you can have the best earnings in the world, but the market again still might gap down. In this case, we were gapping up. So from the previous day close to the next day's open, we were gapping up approximately 14.45%, which is closer to the 15% mark, but you guys get the idea. We are gapping up above a major level, but in this case, the major level was all-time high. Let's now go back on the monthly chart. As I mentioned, we need to mark our levels on the monthly chart. For this stock, it's pretty easy, but we will take a look at the other example as well, where the monthly chart can be a bit tricky. On this stock, it's near all-time high. Monthly chart was looking bullish. We are making a bull flag on the monthly chart. We can see red candle, low volume, green candle, high volume, red candle, the volume has been going down. After the earnings, we were gapping up above this major all-time high, which is approximately 178.36. So the monthly chart is looking awesome. It's looking like a bull flag. So looking really good for a continuation push towards the upside. On the weekly chart, it reported earnings on this week, but basically we were holding in between this range for the past 6 or 7 weeks. I can mark this range for you guys. Holding in between this range. So every time we go near $150 level, we get bought back up, and every time we go near 176, 177, we drop back down. But the good thing is that on the daily chart, we were clearing all these levels. At the market open the following day on Tuesday, 1st of August, the day after it reported earnings, we were gapping up about that previous high week. So the previous week high was approximately 175, and the week prior to that high was 176. But the good thing about this stock is that after the earnings, we were gapping up above all these levels. The open of this day was 177.50. So this just means people who shorted it right here, people who shorted it on these 3-4 big red days, they will all get stopped out. So if you are short selling, and if after the good earnings the stock gaps up above the entry point, you will most likely exit your position. And when you exit your position, that means you have to buy your shares back, and that's why we saw a nice push towards the upside. So the first point, check, because the market cap was around $45 billion before the earnings. The second point is that the gap up was less than 50%. This was right around 15%. The third point was that this stock is gapping up above a major level. That means that it's gapping up right near all-time high. So this stock is a perfect candidate for a catalyst gap play because it's satisfying all these 3 points. So let's now take a look at the 1-minute chart. So after the earnings, I'm going to remove this gray zone just to keep it simple. These are the levels we were watching: 176, 176.85, and basically 178. So this stock opened right at 9:30 a.m. because sometimes it's common for NYSE stocks to have a delayed open, but in this case, it just opened at 9:30 a.m., which is pretty good. We had high volume, tried to push towards the downside, held this $172 level with a doji right here. Next candle, we had a strong green candle right here. And then we started consolidating between 175 and 173 zone. And also there was a really clear signal on the level 2 on the book map that buyers are stepping up at 170. Those same buyers stepped up at 171, and those same buyers stepped up at 173. So this was a good signal bar, kind of a quick flag pattern on the 1-minute chart. And if you entered your position on this candle, I entered this position, I entered 180 calls. I was trading options on this stock. I entered 180 calls. My fill price on this candle was 2.2. The same premiums went to 4.6 at the top. That means you could have more than double your investment. That means if you invest $220 on this trade, your return was around $460. That means you were $240 in the profit for investing $220 on this trade. And that's the beauty of this strategy, because this strategy has very high risk to reward. On the other hand, if you guys were trading stocks, if you guys were trading shares on this stock, you could have entered around 174 with the stop loss under 173 because there was a big buyer on the tape at 173. And then with a $1 stop loss, you can practically easily catch a move towards 180. That means you're risking 1 point against you. If you enter at 174, it went to 180. You're risking 1 point to make 6 points. That means 6-to-1 reward to risk ratio. In case of options, my investment was just double. My return was just double the investment, but my risk was around 50 cents. So in my case, my entry was $2.2. I entered 180 calls. My exit price, my stop loss was $1.7, and the premiums went to $4.6. That means my risk was $50 a contract, and my reward in this case was $240. So that also turns out to be around 5-to-1 reward to risk ratio. When you are trading shares, it was 6-to-1 reward to risk ratio. But the thing about this stock is that, yes, worst case scenario, you could have easily made 4-to-1, 5-to-1, 6-to-1 reward to risk ratio. But this trade had the opportunity to give you 16-by-1 reward to risk ratio. How was that? Because the high of this day was above $190 level. Yes, you can't catch the bottom and top of the stock market, but I will show you guys my entries and exits and try to explain where I am coming from. My entry on this position was at the bottom of this second 5 minutes candle. Then we consolidated. We made a quick bull flag right here. I was holding 30% of my position for a big push towards the upside. We broke out of this flag pattern, and then at this red candle, I got faked out. Honestly, I should have held my position for a bigger push towards the upside because I was only holding 30% of my position, and I was expecting a push towards 190 because the stock was at all-time high. But I paper handed my position, so that means I exited my position a bit too early. Now again, you can't catch the bottom and top of the stock market, so I always recommend to have a technical kind of take profit. So my review to myself for my own trade, I should have held my position, 30% of my position, until it makes a new 15 minutes low. Because if we look at the 15 minutes chart, we made higher low, higher low, higher low, higher low. We kept making higher low until it broke 190. At this doji, this was a sign of weakness because we just had straight green candles. This candle we made officially made a new 15 minutes low. So this could have been a nice take profit of my 30% position. And those same premiums went from $2 to approximately $11. On the other hand, if you guys were trading shares and you entered at 174 with the stop loss at 173, obviously take your partial along the way. But if you're holding maybe 10 or 20 or 30% of your position until it makes a new 15 minutes low, you could have easily exited your position at 190. That means you risked $1 to make $16. 16 to 1 reward to risk ratio. So this trade gave you the opportunity to have insanely high reward to risk ratio, and that's why this is a playbook trade, and it's a playbook catalyst gap play. Let's now take a second example of a trade that I personally missed, but this was again a playbook setup of catalyst gap play. So Roku also reported earnings recently. This is the monthly chart of Roku. It reported earnings end of July. On the monthly chart, we had a push down making kind of a flag pattern. We can see had a bullish move up. The prior month before the earnings, we closed like a doji, but it's looking good because if we break this monthly high, if we break this $75.45 level, that means we officially make a new 1 month high, and we might see a good push towards the upside. The weekly chart is looking much better than the monthly chart. On the weekly chart, we had a push towards the upside, consolidation, push towards the upside again, got rejected. Before the earnings, we had a nice green week, and then we had quick red week right here with low volume. Volume analysis is also on point. On green weeks, high volume, red week, low volume, green week again, high volume. The prior week before the earnings, red week, we had low volume. So volume analysis on point. And the market cap of this company, if I show you right here, is around $12 billion. So this stock satisfies the first condition that the market cap of company is between $10 to $200 billion. It satisfies the second condition, which is the gap up or gap down under 15%. So before the earnings, this stock closed right here. After the earnings, it's opened right here. This stock was gapping up approximately 9.96% after the earnings. So that means it's gapping up less than 15%, satisfying the second condition as well. The third condition was that this stock is gapping up or gapping down near a major level that you mark on the higher time frame. So we just marked the $75 level, and this stock after the earnings was gapping up right around $75 level. And that is the reason, again, this is a playbook candidate for a catalyst gap play. So let's take a look at the intraday time frame and your potential entries and exits on this stock. Let's go back and look at the earnings. So what happened after the earnings? We gapped up, opened right around $75 level. The low of this day was 74.86. Off the open, we straight push towards the upside, and the exit criteria on this trade can also be until it makes a new 15 minutes low. It made a new 15 minutes low after the break of $85 level right here. Even if you look on the 5 minutes chart, we had no reason to exit because this was a really strong push. Even compared to ANET, this was a better push towards the upside. We made a new 5 minutes low after it broke $81, $82 level right here. The premiums already moved 300% by this candle. It made a new 5 minutes low on this candle, but it made a new 15 minutes low after the break of 85. If you catch a move from 75 to 85 on Roku, you could have practically 10-folds your investment because this was a Friday. If you went for 80 calls on a Friday, same day expiry contracts, they opened around less than $1. And at $85, they were approximately $5 to $6 because they were in the money. That's why this trade is also a playbook catalyst gap play with insanely high risk to reward trade. Again, if we go back on the 1 minute chart and we can see our entries and exits, even if you missed that initial push towards the upside, we had a quick flag pattern right here. So this was a pretty hard move to catch. Right off the open, straight push towards the upside. It's difficult to trade options after the earnings because the IV is really high. Even if you're trading shares, sometimes it's better to wait for the first 3 to 5 minutes of the open. If you waited for the first 5 minutes, we had a quick flag pattern right here, push towards the upside. Even if you catch a move from $77 to around $85 or $80, that is again A very high risk to reward trade. Another really good example of catalyst gap play was on W. I recently made a YouTube video breaking down this whole strategy and the level 2 and where I entered and where I exited, because I made $10,000 on this trade with an investment of less than $5,000. So that video is a must watch, but you guys can see the same criteria here. Had a bull flag on the 1-day chart. Next day after the earnings, we gapped up, had a pullback to the prior level and had a nice push towards the upside. If you want to see an in-depth review and in-depth breakdown of this trade, check out the video that will be linked at the top. Another really good example of this strategy was on Netflix recently. So again, Netflix is a large cap stock. It was mega cap at one point of time, but at the moment the market cap is 191 billion. But at the moment, the stock price is around $433, but we are not talking about now. What happened in February, January end, the stock price was around $330. So the market cap was most likely around $150 billion. Again, a sweet spot between $10 billion and $200 billion market cap. So that means it's satisfying the first condition, the first point. The second point was a gap up less than 15%. This stock after the earnings was gapping up approximately 5.33%. So the higher the market cap, the lower the gap should be. And if the market cap is low, the gap can be a lot higher, again because of the reason I explained in the first point. This stock after the earnings was gapping up around 5.33%. Similar kind of setup. We had a pullback to the prior support. Resistance turned into support, had a good push towards the upside. And this is actually a homework for you guys. Go back and look at the intraday chart, 5-minute chart and the 15-minute chart of Netflix from 20th of Jan 2023. 15-minute chart doesn't look really good, but we had a really good push towards the upside right off the open. If you are able to see the similarities between the strategy we talked about in this video and this trade, let me know in the comment section below. The one thing I want to point out here is that any trade you take in the stock market has risk involved. And that's why never in this video I said that this strategy has a 100% win rate. You can't lose on this strategy. Yes, you can lose. The exceptions are always there. It's always about risk to reward. In all these examples, I told you guys, you are risking $1 to make $5. You can risk $10 to make $50 or $100, because every trade you take in the stock market is a game of risk to reward. And also the other thing is that exceptions are always there. Sometimes a stock won't satisfy all the 3 points, but it can still be a really good catalyst gap play. Especially the second point, I want to mention that higher the market cap, I want the gap up to be lower. For example, if the market cap is around 200 billion or even 500 billion, but I want the gap up to be small. The gap up should be less than 5% or maybe the gap down. But if the market cap is low, for example, we saw that W trade, that stock was gapping up 15 to 20%, but the market cap of that stock is only $10 billion, around $8 to $10 billion. So it's barely making that large cap stock. So in simple terms, lower the market cap, the higher can be the gap up or gap down, but higher the market cap, the lower should be the gap up or gap down. If you guys stuck around until the end, I'm pretty sure that you guys are dedicated, serious day traders similar to me. So make sure that you guys give this video a thumbs up, because it helps out the channel a lot to grow and reach new traders out there. If you guys are new, subscribe to my channel for a lot more content on day trading. And before you go, if you guys don't follow me on Instagram, I post a lot of good content on Instagram as well, including trade recaps and my life outside of trading. The link will be in the description box below. Thank you for watching, and I will see you guys in the next video.